Yes, hello. Good morning, Mike. Sorry. Thank you for the opportunity. My name is Shalako Viener. I'm a Senior VP at Bank United, regional bank based headquartered here in Miami, with over 32 billion on assets. And I'm the head of everything that is working capital solution for the bank. And if you want to pass to the next panelist, maybe Willie.
Hi. Hey, Willie.
Hey, I'm here, guys. Willie Gomez. I'm the regional president for Wood Forest National Bank, a community bank headquartered in the Woodlands in Houston, Texas. We're an $8 billion bank. We have a deep specialty in commercial banking. My team from Charlotte, Tampa, and Fort Lauderdale cover middle market from Washington, D.C. down to Florida and some of the adjoining states as they go westbound. Very happy to be here, and thank you for having us.
Hi, thanks, Mike. Nick Perkin here. I'm Chairman and CEO of Perkin Industries. Perkin Industries is a sort of a hybrid private equity firm. We buy what we like to refer to as we focus on stepchildren businesses, by which we mean non-core businesses to larger core businesses that are selling those assets. So we have a team that we superimpose over any assets that we acquire. Probably about 15 companies in our portfolio, spanning every industry that you can pretty much imagine: healthcare, aerospace, hospitality, media, new media, you name it. We buy about a company or two per annum. Typically, the companies are sort of sub 5 to somewhere in the range of sub 7 million of revenue. Prior to that, I guess my most relevant experience with the credit side is I built a company called the Receivables Exchange, which we sold in part to the New York Stock Exchange, which is now called LiquidX. Was acquired by the guy who built LiquidNet, I believe, or one of the large fixed income platforms. But that was a large marketplace doing several $billion of online transactions of receivables, both small company and large corporate, and has pretty much moved over to the large corporate, competing with the commercial paper side of the equation. So we built that company up from just me to about 125 people, and then over time sold it. And then prior to that, I built a company called Massive, which we exited to Microsoft. So I've been in the business of building companies for a while and selling them, and then went into the business of buying pre-existing companies and growing them.
Okay, thank you, Nick.
Shalako?
Yeah, I'm here.
Roberto Munoz is on now. Roberto,
Okay.
Are you there?
Yes, I sure am.
Okay.
Can you hear me?
Yeah, we can hear you loud and clear.
Great.
Just a quick update. We got into the introductions.
Sure.
And so far we've gone through Shalako, Willie, and Nick Perkin. And now we have Deepak Jogia, and then we'll turn it over to you.
Great. Sounds great. Thank you.
Thanks. I'm Deepak Jogia, managing partner and co-founder of Highmore. We're an alternative asset management firm headquartered in New York, advise on $2.3 billion of assets. I had the specialty finance business, and we launched a trade finance effort just over 2 years ago, providing working capital release solutions to both middle market and lower middle market companies. We do that across a range of industries. So our financings range from supply chain financing, accounts receivable discounting, and purchase order financing. And we do that for both institutional investors and high net worth individuals.
Great. Thank you, Deepak. So Roberto, why don't you introduce yourself and
Great.
then go into the opening statement about the actual panel.
Good. I appreciate that very much. My name is Roberto Munoz, and many of you already know me through past seminars that we have put on, webinars, and direct meetings in New York and Miami. And so I'm pleased once again to have this opportunity to work with Flya, where I'm a board member, and work with Michael Corselli and his team that always do such a great job in making sure that Flya is a marketplace for information, but also for deals to be done, people to meet, and activities to occur, which creates a very unique platform among many in the marketplace today. So thank you, Michael, for that. Again, Roberto Munoz, I'm a 40-year banker. I'm currently the market president for First Horizon Bank in Miami, which is a $48 billion bank out of Tennessee. We've recently also announced a merger with Iberia Bank, another 30-something billion dollar bank out of Louisiana. And so the combined entity will be about $70 billion, $75 billion worth of assets that we are still in process of being approved. Through regulatory authority, shareholders have approved this. So it'll be a juggernaut of a bank for the Southeast USA. And we'll be doing a lot of business in the marketplace as we roll forward beyond the current environment that we're in today. I'm also the chairman of the World Trade Center Miami, which is the global World Trade Center. There are 300 centers around the world. I'm the chairman of Miami, and we are the primary trade and logistics organization for South Florida. And of course, trade and logistics is what really is what this particular marketplace is all about. South Florida is trade and logistics in a big way, and that is economic engines include the airport or the airports. There are 3 of them, and the ports. There are 3 of those that drive our trade and economic development down here. I'm also the incoming president of the Boy Scouts of America, a great organization, and I'm the secretary for the Beacon Council, Miami-Dade Beacon Council, which is our PPP Economic Development Board. And I'm also the treasurer of the Greater Miami Chamber of Commerce, to mention a few. In my 40 years of banking, I've spent about 32 years of those in senior management roles with the likes of Barclays Capital, Mizuho Finance, which is a Japanese Mizuho Bank, Israel Discount Bank of New York, and BBVA, the Spanish bank, in management positions including president, market president, chief lending officer, chief representative, etc. And in the areas of upper corporate, mid-market, public finance, international finance, M&A, and project finance, mostly in the state of Florida and LATAM during this period of time. Today, as you can see, we have a great set of speakers. As today's moderator, I'm glad to bring you these great individuals with great experience in the area of banking and direct lending. And I know that they know their game very well, and they're hard at work every day to build success. So before I ask the first question, which I'm going to start now, what I will say is the following. There's headlines that just came out that Bank of England is selling negative interest rate instruments for the first time in their history. And believe me, don't ask me what that really means. But if anybody on the phone understands negative interest rates for government bonds, that's a very interesting moment. And we're living it right as we speak in today's environment. So I'm going to go right into the questions. But I will say the following: in an environment of uncertainty where cash is king, what are banks and direct lenders thinking about post-pandemic? Of course, we're in the pandemic, but we have to come out of this. So I'm going to call it post-pandemic. Now, we do know pre-pandemic, the global economy was buzzing along on 3 cylinders. I can say that even though the US was steaming along on all 4 cylinders, but we do know that China, Germany, and other European countries were showing signs of financial fatigue last year. They were showing it last year, and as measured by slowing GDP growth. So of course the pandemic has hit all economic engines pretty much around the world. And so what we're seeing today is something that we haven't seen, as we all know, in the past. But let's get back to where we are today. And today's panelist, I'm going to ask, and I'll start off with Nick of Perkins Industry, who just gave his introduction. Thank you, Nick. You had a great introduction. That's where I picked on. What do you see today as we reopen the market post-COVID lockdown? And the second part of that question is, where are the opportunities, or where do you see the opportunities? So what are you seeing today? What are you seeing today as we open the market post-COVID?
Thanks. So, I think for us, in many ways, the current environment post-COVID is a more fruitful proving ground, hunting ground for us in terms of what we specifically do, right? Because when things are booming and going along, we have a more difficulty getting the kind of multiples that we want to pay. We typically don't pay more than 3 times cash production from the business. So in the current environment, with what we look for, not to be negative towards stepchildren, but we call them stepchildren businesses internally just because it's non-core businesses that don't get the same focus that the core business would get. So companies typically hang on to those, and we buy ones that produce cash. We only buy cash producing companies. So companies now are shoring up their balance sheets, trying to be conservative, as you pointed out. And so it's a great time for us to be looking for those types of assets, engaging with companies that want to spin off an asset for cash and focus on their core business and shore up their balance sheet. So, we're seeing more and more of those opportunities, certainly more of those opportunities than we would have seen when the world was firing on all 3 or 4 cylinders. And it's an interesting time. We're not yet seeing the lack of access to capital that people are worried about. So we're pretty optimistic. We think it's a very short window, and we think that 6 to 9 months from now, if we don't pick up assets, that those assets will already be priced higher from where they are now.
Okay, very, very good. Thank you for that. I would like to ask the same question of Willie Gomez. Well, let me just repeat the question. What are you seeing today as we reopen the market post-COVID lockdown? And the second part of the question is, where are the opportunities? Thank you, Willie. I think you're on.
I apologize, guys. I was trying to be polite by being on mute and I couldn't find the cursor.
Did you hear
Anyways,
the question? Okay.
Yes, I did. Yes, I did. Before I talk about the current situation, let's take a brief step back and reflect upon where we were at the beginning of the year in the last quarter of 2019. The United States was enjoying the longest recovery in its history, and everyone was wondering when we would enter a recession. The U.S. has been in the midst of a trade war with China, and to a much smaller extent with several other countries. This was financially disruptive and had a dramatic impact on supply chains. The United States was actively changing its sourcing to diminish concentrations. We had been in a transformational process from bricks and mortar to online. The lending market was red hot, so much so that the banks were being further disintermediated. Manufacturing had experienced a small recession. Aviation was beginning to experience issues with the Boeing aircraft issue. Private capital overhang was almost $1 trillion higher than it was in 2008. Sales multiples were at pre-Great Recession heights. Now, overlay to that, COVID-19 and the oil crisis resulting in the most dramatic shock that the United States economy has ever experienced as measured by GDP. And what do we have? A recession that we were all waiting for. Although I agree with Nick, it's going to be a short one. A continuation of diminished reliance on Asia. An acceleration of the retail collapse. Aviation is under immense stress. A cooling in the lending market and significantly more diligent lending. A shift in investor mindset. While dry powder is an all-time high, it is focused on mega funds with well-established players completing mega deals that were diligenced in the last quarter of the year. Smaller funds and new strategies are not being successful. Capital calls will be to complete these deals in short portfolio companies. After that, deal activity is expected to ground to a halt. Most of the attention today on private debt markets is focused on opportunistic strategies, hoping to capitalize on recent market dislocations. It is worth noting that almost 1/3 of the United States debt is now considered distressed. A flurry of mega funds focused on distress and special situations have come to market, and the United States government has undertaken an unprecedented stimulus package. So what does this mean for opportunities? Many banks are rightfully internally focused. This means that they are not focused on their customers. Some banks are literally shut down. Their clients are vulnerable. Banks will lag in direct lending response as they recover from the impact of the crisis, opening the markets to NBFIs, non-banking financial institutions. As companies continue to change their sourcing, they will need credit to support this transition. They do not have 10 to 30 years of trade experience like they did with their Chinese vendors, and high uncertainty will require credit enhancement. Supply chain and factoring are the ideal tools for this. Distressed lending will be in high demand. Banks will continue to leverage the government programs to support their clients and capture new opportunities. Acquisitions will happen, but at a slower pace and at lower multiples, as some owners simply run out of resources to survive, yet have viable businesses. And lastly, aviation will languish as these factors, which are not yet fully done, flow through the industry.
Thank you, Willie. I appreciate your comments on that. I also just came off of mute. Sometimes it takes a couple of minutes to get there. Deepak, listen, nice presentation by you. I would also like to make the same question. Where are you seeing today as we reopen the market post-COVID lockdown? And then the second part of the same question is, where are the opportunities?
Right. Well, I'd like to, answer it from two angles because I know on the call, the webinar today, we have investors, high net worth family office institutional investors, and the investors are thinking about, in a world of uncertainty, which is frankly where we are today. Where do I invest capital? Do I hold cash? Is the opportunity of holding cash really high? And certainly if you look at the public markets today, they're telling you one thing, and they're telling you that the governments have stepped in and provided liquidity and look beyond the next 2 years, and in 2021, later in that year and beyond, we're going to be okay. But the reality is, I think it's too early to tell where we are and what's going to happen. Will reopening result in businesses really coming back? I think what we really need to think about as practitioners in the business, but also the investors who are listening today, is how will consumers consume, and how will businesses conduct their business going forward? It's a real unknown. And I think there's a fair amount of uncertainty. So against that uncertainty, how do you think about doing deals? Do you simply step away? And I know we have some friends and colleagues on the panel who work at banks. It'll be great to get their perspective of what's happening from a traditional financial institution standpoint. But we're a non-bank institution, and for us, we have certainly capital, we have speed and certainty of execution, and we work strategically with companies. We've had certainly a 10-year, 11-year run of markets really going one way, and a lot of capital coming to this space. But the real test is in a downturn. It's easy to put money out, it's harder to get it back. And can you really engage with companies in that entire process? So for us, against this backdrop, we have been active. We have been funding transactions. But for us, it's really been things that certainly it's become flavor du jour, talking about essential goods. We've not done any PPE transactions. We thought they were just too opportunistic. Certainly much higher risk there when you really look under the hood, both in terms of thinking about fraud risk and certainly operational risk with people who have no history in that space. But in terms of funding things in food and beverage, in the aftermarket space, in the auto industry, so non-OEM business, pharmaceutical transactions, refined fuels for shipping, where you have certainly a predictability of demand and you have good credits on the other side. There are deals to be done where you can earn an attractive risk-adjusted return. But I think it's very much, feeling our way today as a group of what will happen. Will there be a second wave? A lot of unknowns. But I think the benefit that the collective group that you're listening to here on the panel today have is beyond just being in a private market, is just the structure and the control that we can bring to transactions.
That's excellent. Okay, thank you very much, Deepak. I'd like to ask Shalako the same thing. Shalako Wiener, how are you, my friend?
Very good, thank you.
Good. I want to ask you the same thing, and let me repeat. What are you seeing today as we reopen the market post-COVID lockdown? And number two, the same part of that is where are the opportunities?
Yeah, thank you, Roberto.
Thank you.
Thank you, Roberto. And after all the panelists, I have to agree with their position. I think it is key to understand that we are in a new economic transformation. I think the world came from industrial revolution to the internet booming, and then globalization, which unfortunately COVID make us realize that globalization is good, but also have its downfall, seeing all the impact on supply chain and the way to get resources far away from the center of transformation or distribution or consumption. So I think that COVID-19 is going to rethink a lot of things in terms of quality of life, in terms of community, in terms of politics, and it's going to be a big reinvention with a big generation change. As we know, a lot of baby boomers are going to be in the process of retirement, and there is new generation coming up. And then for us as a financial professional, I think the key is going to be how we work together between the fintechs, the technology power, all this platform and way to transact that give more transparency, better compliance, and then alternative finance, which been since 2009 a key element of direct investor companies like from Deepak or Nick, that they're more active, and then the traditional banking, which is becoming more and more platform for transactional than risk management. So I think the key and where the opportunities are is how we all connect together, with each of us having our specialty and our niche. As there is enough need and enough business opportunity right now with good returns. Of course, I would say right now, what is key to understand where are the opportunities, to see who's going to be the winners and the loser of this crisis. And we're going to see how these industries start getting transformation in the way of consumption, distribution, and reaching out to the final client. So it's going to be key to understand where we go and how we combine all these elements.
That's great. Thank you for that. And as we move on to the second question, right before we get on that, I got to tell you that from my point of view, it's very interesting how the government's getting involved in the marketplace. I've never seen a marketplace, of course it's needed, but where the government pretty much is going to have a huge balance sheet, up to $10 trillion at the Federal Reserve, where you have multiple stimulus programs occurring at Treasury through the SBA, and whereby the United States government will control a lot of the assets that are out there. And hopefully in this gyration of activity, that the asset bubbles are not uneven and that we're able to price risk accordingly. But again, it becomes very difficult when you start buying huge pieces of debt and then pricing it in a certain format, and then coming out of the recession when you want to sell it. There creates these gyrations, but that's where we are today. As I go to the next question for my panelists, has the marketplace changed? Now it's an interesting question because of course the answer is yes, but the point is this: has the marketplace changed? And the question is, how are you approaching the market? By industry, by revenue size, or by geography? And I'm going to ask Willie Gomez to take the first round on this question.
So, by the way, your comment about the government and inflating its balance sheet, I've always asked economists, is it okay to issue debt and buy your own debt forever? And that's basically what the government's doing. So none of them seem to have a good answer to how that plays itself out. Anyways, to your question, what has changed? I'm going to very briefly read some statistics that I received from Fiserv. In the first 2 weeks of April, credit card receipts for travel were down 96%, entertainment and leisure 81%, clothing down 98%, upscale restaurants 88.5%, casual dining 77% down. So what has changed? If you're a restaurant, travel, ALFs, hospitality, and retail, banks aren't going to be able to help you now. Few will meet the credit standards that banks have. While we at Wood Forest have certain sectors covered, such as aviation, food and beverage, healthcare, insurance, etc., we tend to be generalists and follow our clients and sponsors around the United States. My region encompasses from Florida up to Washington, D.C. Cash flows, capital and supply chains have been adversely affected, making any type of long-term lending difficult. Most of our lending right now is short-term. Cash flow lending is going to be very difficult in the coming 6 to 9 months. Pricing has changed to more accurately reflect current risk. LIBOR floors are being input in deals. There's been a drift within our credit underwriting to find the highest credit standard within our borrower. So we're looking at the borrower, the vendors, their customers, and then think supply chain. As was mentioned earlier, that's a good solution for things that are working right now. Industries that seem to have fared best so far, trading companies with strong cost controls that have adjusted to the trade war. Any company that provides internet service, NBFIs doing factoring and or supply chain, not working capital or acquisition financing. Some healthcare segments, pharma, doctors, physicians, anyone doing business with the government, insurance companies, infrastructure companies, people that have creative solutions to the current crisis. As was mentioned by Nick, we expect to see spin-offs as underperforming segments or unimportant segments as perceived by the owner are get peeled off or executives get fed up or fired and start their own businesses. Those companies will need the support of NBFIs. And we're continuing to support our sponsors that have behaved during this crisis. Some tried to use the 2008 playbook and did nothing but annoy most banks since it wasn't an appropriate approach at this particular time. So we do see opportunities out there. We are lending, we are closing business, but we're certainly being a lot more selective than we've been in the past.
Okay, great. Thank you very much, Willie. Appreciate that. I'd like to go on to Deepak with the same questions. Let me repeat, please. Has the marketplace changed? How are you approaching the market? By industry, by revenue size, by geography?
Thanks. So we've observed, from mid-March, and we fund, as I mentioned, across middle and low middle market, but we're also active in the investment grade space. And we've certainly seen a cooling off by institutional investors who used to be, really active funders of investment grade paper. That paper was, pricing extremely tight as it should, reflecting the credit quality, but it was being absorbed in a blink of an eye. And COVID-19 occurred, and you started to see paper sit there for longer, reflecting risk aversion and desire to preserve liquidity. And we've seen deals priced wider. There's a healthcare company, investment grade, selling investment grade AR, used to price at LIBOR plus 60 basis points. And we did trade that for one of the pools that we run. And we got LIBOR plus 350 basis points. So it gives you a sense of the ability to negotiate with a company and the ability to earn a higher yield. When we think about the middle market and lower middle market, we've always had an approach of focusing on businesses that are really established, where we're financing growth, businesses that don't take significant amounts of inventory risk, and there's a predictability of demand. I would say that we're certainly seeing the ability to earn a high yield as liquidity dries up. But I think more importantly than that is the ability to, I think, drive terms when you structure these transactions. whether it's complete a wrap of the company. For example, we financed a deal and started a program with a company that's in the smart meter business. Company does about $60 million of top line revenue, very profitable, held by a wealthy family. In a pre-COVID-19 environment, we would be having notification of the account debtors and having a lien on the accounts receivable. In this backdrop, beyond the rate that we're earning here, which is about 15% on a gross basis, with the tenor of the transactions being about 90 days, we have basically a blanket lien over the entire business, and we have a guarantee from the owner, and the owner has meaningful net worth for the guarantee to have some real teeth to it. So I think the structure, beyond what you can earn, I think we can certainly drive the terms with these companies to better secure ourselves.
Thank you very much, Deepak. I'll proceed on with the same question and respond to Shalako. Again, has the marketplace changed? How are you approaching the market? And as an example, by industry, by revenue size, by geography.
Yeah, thank you. Definitely, we agree with Deepak. We're seeing, even though the cost of money, because of the Fed seems lower, I think that the cost of money is going higher. And because we are in a situation that we approach more our relationship. Finance is a trust business at the end, and you have to be close to your relationship. And right now, we're a lot of at least on the banking side, we are kind of protecting our relationship, our clients, in order to turn this crisis. It's not a moment for expansion, but it's a moment to understand which are the relationships that's going to be able to survive through this crisis and see how they transform their business. We monitor a lot of the sales of the company, which in general, I think any company that understands where they can turn around is more on the cost control. So procurement is going to be key, and that's why supply chain, and I'm always been focusing short-term working capital solution. Because of that, you need to turn how you turn around your cash, maintaining your margin. So if your sales go down, you need to find a way to reduce your cost and keep your margin. So I think we're going to be more on a regional relationship right now and more close to the business, and tie more the structure to the cash conversion cycle of the companies. And as always in this industry, more diversified you are, the better you can absorb any downturn of it. So I would say that, of course, there are certain sectors that are not going to recover for a long time. Again, hospitality, direct restaurants like you're sitting, and the travel and leisure industry is going to take a while everyone feels comfortable. All the rest industry, the food, the logistics, healthcare, they're going to continue to do it well as the consumption is still there. So it's just the way to access the new products or the new channels, what is going to be key, and that's the sector that we're looking for, which having a better return. That's where alternative finance have a big opportunity now to enter this space of short-term financing.
Excellent, Shalako. I'm going to ask the same question of Nick Perkins. Nick, I want to repeat the question, Nick. How has the marketplace changed? And how are you approaching the market? By industry, by revenue size, by geography?
Thanks. So, our playbook is pretty much the same in terms of revenue size and deal size. I mean, we have a very specific protocol that we utilize to determine buy. So that's not changing. I think on the industry side, for sure. I mean, I think that there's, clearly areas where we don't want exposure. There's going to be, but some of those areas actually have opportunity in them. So I don't know that we will stay under this tactical tilt for the long term. It may be 6 months from now, where there's enough, blood in the streets in a particular set of assets that it might be time to step in. I could certainly see, us taking a look at areas that are going to just be in bad shape. I mean, I think that, but for now, at the moment, we're not getting into things until we have greater visibility into how those particular sectors are going to play out. But it doesn't mean that we won't change our minds in 3 to 6 months. So, the sectors are, we would stay out of, for the moment, hospitality. We would stay out of anything that has anything to do with foot traffic, anything that has to do with people traveling, anything that has to do with anything that is not. I mean, we're largely B2B focused anyway, so we wouldn't really do much on the consumer side, although we have one consumer play, which is a hand sanitizer company. So it's the one that we were actually in that 3 years ago. So it's fortuitous, not necessarily in a happy way, but it is fortuitous. And but I think that I think our game plan is largely the same. I think we're going to look for opportunistic buys. We're kind of standing by to try to figure out what does it mean when the Fed and the U.S. government is going to start playing in the getting cash into the hands of SME companies. It's TBD. It sounds like they want to get that firing in June. So it's going to be interesting to understand the particulars around that. But I think our game plan is largely the same. I think that the world is in flux, but nothing that, for those of us that live in Louisiana and other places where there have been major natural disasters, not a playbook that we haven't necessarily seen before, just on a much larger global scale. But the stages of grief, or the anatomy of the process that we're going to go through, are going to be very similar to any other natural disaster that you go through. And so we're kind of what you've seen in post-Katrina, post-9/11 type environments, to sort of position ourselves to where we want to be and what we want to be in. So we're cautious in terms of affected assets now, but we're keeping our ear very, very close to the ground, because we believe that when things turn, they're going to turn pretty aggressively.
Okay, this is good. I will ask the audience, please begin formulating any questions that you have using your chat as I go into the third question. This way we can at least have a lineup of what questions you might have, and particularly who you might want to answer or who you're asking the question to. So we'll open up the chat line right now as I go into the third question. And I'm going to start the third question with Deepak. And Deepak, what type of assets are you looking to finance? And what financing model are you deploying?
So everything that we do is linked to accounts payable or accounts receivable. So we do supply chain financing. We do accounts receivable discounting. One model that we've really developed over the last year, it's really focused on the lower middle market companies. So businesses that are anywhere from 20 to $100 million of revenue, where we will work with them on the accounts payable side, whether it's supply chain through offering early payment discount to their suppliers, or where we actually act as the buying agent for inputs, and in a flash sale resell to the buyer with a marked up invoice, where we take the credit risk on the buyer. But what we've also found is a way to protect ourselves from a risk standpoint is looking to their accounts receivable. So they ideally have a decent level of diversification across their account debtors. So if we're financing them on the payable side, can we get accounts receivable redirection? And if we have accounts receivable redirection, then it's easy to go to the next step to discount those invoices. And that way, through just the control of cash flow, we just increase the certainty of repayment. So for us, beyond industry selection, beyond thinking about the management team running the business, getting the structure right is critical.
Thank you, Deepak. Let me continue on now with Shlako with the same question, number 3. What type of assets are you looking to finance, and what financing model are you deploying?
Yeah, so again, in the bank, my practice is on working capital solutions. So I work in short term, and what I try to always is improve the cash conversion cycle of my clients and relationships. So we always think that this kind of structure, they are self-liquidating. So pretty similar to Deepak in a way. Always look for who are their clients, who are the supplier, and what are the payment terms. And see how we can free that cash that is trapped in the supply chain process, seeing that you know, we can pay early the suppliers and then or do the collection for them on their client side, or if they have some inventory trapped that have certain value, that we can free some cash in order to the business to grow. So it's always key. I always mention to my client and this type of structure, when you are in a growing phase, you always struggle with cash. If you grow too fast, you run out of cash, and then you get in trouble. If you go too slow, you get a competition. I would say at this moment, my major approach and concern is more on the supplier side. This is a supplier marker. The demand, if you are in the right industry, is there. The consumption is there. What is getting more difficult right now with all the logistic problem caused by COVID is how you get the raw material that you need to process, or the right services that you need to process. And one example of that, if you see in the food industry in the US, where there have been some disruption and concern, it was not because the meat or the food was not there. It was the capacity to process because of the illness of some of the employees on factories. So that is where it's key that maybe you're going to need to rehire. And so it's turning around that cash and having the right model and monitoring that you put in place. I always had triggers, and I always monitor the liquidity of the company, which at the end is our source of repayment. So that's it.
Okay, excellent, Shlako. Thank you for that. And I want to go on with Nick Perkins, the same one, same question. What type of assets are you looking to finance, and what type of financing model are you deploying?
Well, you know, we look for assets that produce cash. So really our minimum threshold, and we very rarely go this low, but is 26% cash on cash per annum. So if we put $1 million into something, we expect to generate $260,000 of net cash per annum from it. Our return on capital employed is probably much more around 40%. So we probably do around 40% cash on cash. But you know, we buy things, we grow them, and you know, we're really fairly agnostic when it comes to the type of company. I mean, if it has 5 years of cash production, a sustainable market model, typically. People that we typically don't buy out the entire company, at least in the first year or two, maybe 3. So we'll buy them out over time. That's been a very successful strategy for us. But from an industry standpoint, I mean, we're fairly agnostic. The financing methods, you know, we have bank partners that fund us. We're starting to, because of what we think is going to be a fairly large capital need in the next 6 to 9 months, we're starting to look for partners like business development corporations and others that might be something that we can leverage more quickly. Although our banking partners have been pretty much, you know, have told us that we can buy whatever we want to buy. We maintain an unused line that we've, you know, of which part we can draw whenever, and part we can draw upon presenting the opportunity. You know, I think that, you know, banking has worked very well for us. The question I have right now is, you know, would we be able to scale faster with a hedge fund partner or a business development corporation partner? where, you know, we could have 10 million, 20 million sitting around. Because if we do see 5 to 6 opportunities, again, I think the window is going to be fairly short here, because I think the Fed is going to get very aggressive in terms of putting money to work. And I think, so I think, you know, fight the Fed at your own peril. I think that if you look at the global environment, you know, the U.S. has been much more aggressive in terms of stimulation to the economy. And I think if you look at all the forecasts from all the big names, the U.S. economy is meant to recover more quickly. So, you know, whether it's a V or U or whatever, when it does recover, you know, just going quickly back to the Katrina example, by the time it looks like it's getting better, you already missed the opportunity. So it was the same way down in New Orleans, Louisiana. By the time you know, you realized where this was going, and the recovery down here, which has been nothing short of unbelievable in terms of asset prices. And that was a $20 billion stimulus. So think about the numbers now on a global basis. And I actually think some of our European counterparts will start seeing the effect of the U.S. stimulus and start becoming more stimulus. In fact, I read something to that effect today, but the Bank of England is thinking. So, you know, I think that, you know, we're assessing right now. We're literally just initiating our conversations with business development corporations. We have our consortium of banking partners. You know, I think we're one of the lucky ones, though, because, you know, we're producing cash at very high rates, and we're highly diversified cash flow production. So I think we're, you know, a little bit in the catbird seat. Anyone who is in one business with an exposure, I just can't even imagine what that's like. It's got to be extremely stressful. But a lot of our healthcare stuff is unimpacted, in fact, has grown. And so, you know, I think we'll continue to look at the sectors we've been in. Start closely watching the sectors that we think are hurting right now for when we might jump in. And I think our financing solutions are going to be probably similar. If I had to guess, I would imagine continue to be banks. It's been easier and faster. And quite frankly, the relationship we have with our banks is such that, you know, an extra point here or there, it's not really going to make the difference. I'd rather have a good partner. But we're going to talk to the business development corporations and start initiating hedge fund conversations and see where that goes, just because, you know, for me to pay 5-6%, I mean, I'm doing 26%. So I would imagine there's some people out there that look at 5-6% across diversified cash flows as pretty juicy. So we're going to look at it. But if I had to guess, it'll probably all stay exactly the same. And hopefully we'll get lucky and come across some good assets over the next 6 to 9 months.
That's great. Very, very good. And look, we're running into our third question, which gives us about 10 minutes of time before we get to our Cinderella moment. I would like to make sure I don't see any questions on the chat box, although I'll ask Jeffrey or Michael, does anybody have any questions, number one? And I'm going to go on to a bonus question if not. Michael or Jeff?
So yes, Roberto, there are some questions.
I see them. I now see them.
Okay, perfect. So why don't you select those questions? You have up to 8 minutes before the next panel.
Okay, so I'm going to go in the order, and I'm going to start with Mr. Singh on the phone. Let me just read this. You'll look at any renovative loans. Will you look at any renovative loans similar to opportunistic investment that will evolve over a year or so and then provide returns when COVID crisis is reduced? Nick?
I'm sorry, can you repeat that question again? I'm sorry.
I will. It's a little bit cumbersome, but that's okay. Will you look at any renovative loans similar to opportunistic investment that will evolve over a year or so and then provide returns when COVID crisis is reduced?
What kind of loans?
Opportunistic loans.
Like, would we be out? Would we push loans out to people?
Yes, basically, I guess that's the question.
I mean, we've done that on a converted basis. Obviously, our hurdle, there's very limited states you can actually do 26% returns on loans. I mean, you got obviously the usury concerns. Louisiana is one of them. There are no usury laws in Louisiana. I don't know that we could, with our model, be pushing out loans per se, just because of some of the usury concerns. But we've done it. I mean, we've done convertible loans into equity that give us collateral in the cash flow of the business. So in other words, if there's a business that's generating cash flow that would meet our rate of 26% cash on cash per annum, and we can be collateralized by a position in that company by those flows, that number year on year. So we have started in the past once or twice with a loan convertible into the equity with a loan payment coming in at our cash on cash hurdle rate. So we have done it. It's not my favorite way to do things because it sort of presupposes that something has to go wrong in order for you to get into the cash flow side of it and own the business versus get paid back. But in the case where we did it, it was very, very successful. It was a digital media company, and we ended up getting our 26% on the loan piece for about 5 years, and then still own a piece of the company. And it was, that one was successful. So, but yeah, it's not totally impossible for us to do. It's not really what we do and how we do it, though.
Okay, very good. Thank you for that. Willie, you want to take that question? How do you see any? Will you look at any renovative loans? Will evolve over a year.
I'm interpreting renovative loan to be
Similar to opportunistic investment.
Yeah, I mean, opportunistic investors, the drill with banks, right? Primary, secondary source of repayment. So as long as I got a good primary and secondary source of repayment, in this case, it sounds like the secondary source of repayment is based on time. So you're looking at a 12 months to 18 months time horizon. That's, in my opinion, close to impossible to predict given what's going on today. I agree with most of the panel in that I do expect a recovery, but that wouldn't be what I'd be looking at. I'd be looking at my secondary source of repayment. So it would depend on who it is that is going to support the transaction. As you know, banks can't charge, and they're not designed to charge the kind of rates that you need to. And I think this is best suited in the world of, Highmore and Perkins than it is at Wood Forest National Bank.
Great. Deepak, opportunistic loans over 1 year that will evolve over the 1 year, and then provide returns post COVID.
So for us, it's less opportunistic. I think like Shalako, we like to be programmatic with companies, to have a multi-year relationship with them. Clearly what we do in terms of the transactions, we have non-committed facilities with companies, could be 12, could be 24 months in tenor, but the underlying transaction has a revolving period. So each financing, each discrete outlay to make a purchase could be as short as 30 days, and we go up to 130 days. So for us, we don't necessarily run an opportunistic business because we want it to be a multi-year relationship, even though the financing transactions, they're not term loans. They're short-term, self-liquidating revolving deals.
Great. And Shalako, the last question on this panel, and we will run out of time, probably very close to your question is, are you looking at any opportunistic loans right now that will evolve over the next year or so, and then provide returns when the COVID risk is reduced?
Yeah, I would say similar to Willie and in a way, Deepak, we are highly industry regulated, so it will be very difficult for a bank to take any opportunistic approach right now. We're just going to stay conservative and maybe let alternative finance take those opportunities.
Okay, great. Michael, I'm turning this over to you. I want to thank you for your continued support of the industry as a whole, both direct lenders when it comes to banks and the advisory world and hedge fund and alternative funding world. Thank you for your continued support of all industries and making America great. Thank you.
Thank you, Roberto. You guys have quite a few questions that have not been answered. And, you know, what I would suggest is I will type those questions up and send them out to you and introduce you to the people that have asked the actual questions. So again, thank you to Roberto Munoz, First Horizon, for being a member of FLIA, for sponsoring our events, and for each of the participants on this panel today. You know, you're on the front lines of what is happening, and we really appreciate your interesting insight that you were able to share. So thank you very much for that. I also want to thank our event sponsors, Safe Harbor Equity, Off the Chain Capital, Entrust Global, Apex One Investment Partners, Millennium Trust,